In my last video, I was talking about how you can roll a trade so as to hopefully turn a loser into a winner. But in this video, I wanted to show you some actual examples of trades that I've turned from losers into winners. What did I do so as to turn those losers into winners? I wanted to give you some actual examples and results that I got myself on how I managed to turn some losers into winners, because obviously with examples, it's much easier to understand what rolling actually is. But before diving into this video, if you find this video interesting and you actually learn something like, what is the process of rolling, how does it work, then don't hesitate to subscribe to my channel and liking this video. That's really the best way to support me, and I'd really appreciate it. But before we dive into the Testworks platform and I actually show you trades that I've turned from losers into winners, if you don't know what rolling is, then I highly suggest you to watch my previous video where I explain what rolling is, how does it work, why do you want to, for example, roll for credit, and all of this type of thing. So if you're not aware of what rolling is, I highly suggest you to start watching that video first and then come back to this one so you can actually see some examples. And you'll basically go from theory to practice. So that's why those two videos, the first one was really to be there as a theory video, and then after that, here it's more practice and actually show you some real life examples. So now that we covered that, and now I assume that basically most of the people know what rolling is, let's dive into the Testworks platform so I can actually show you some trades that I've turned from losers into winners. So the first underlying where I had some issues, where I had some losing trades, but I still managed to turn them from losers into winners, it's on the ETF GDX. So if we look at the chart, you can see that GDX have had some wild move those recent weeks. It actually went up like crazy from like $31 to almost $40, and then now came back to $34. So what did I do on GDX in the first place? Well, on May 3rd, I sold what we call a call credit spread. And you sell a call credit spread when you have a bearish assumption about the stock or the ETF that you're going to trade. So in our case of GDX, I sold it on May 3rd. So basically on May 3rd, I was bearish on GDX and I sold a call around the 38 strike. So if we look at where is the 38 strike, that's basically there. So I was betting that the stock would go down and that by selling that call credit spread, it would stay out the money and I would make a profit that way. However, as you can see, the stock didn't go in my favor, it actually went against me. So I found myself in a position where I had a loser and my strike got breached. I mean, you see that the stock on May 17 topped almost $40 per share. So I was in a losing position. So the question is, how did I manage that call credit spread that went against me? So if we go actually into my trading statements, we can actually see all of the transactions that I've been doing on, for example, GDX here. So on May 3rd, you can see that I sold that call credit spread, I sold the 38 call and I bought the 45 call. Then on May 27th, so on May 27th, it was basically when the stock was around $39 per share or somewhere around this. So when the stock was around that level, so you see that it was actually really the high, and that the stock would after that come down, but obviously I didn't know this. So I was rolling my trade and I was in a position where my trade was a losing one and I was losing money, but I didn't just want to take my loss. I thought that the trade could actually come back in my favor if I was giving it more time to be right, and that's what I did. So on May 27th, I basically closed my call credit spread position. So you can see that I bought to close the 38 call and I also sold to close my 45 call. And I basically opened another call credit spread and I actually opened the same call credit spread at the same strikes, but in the July 16 expiration. So you can see within those blue rectangles that I first closed my call credit spread in the June expiration, and then if I take another call, so maybe it's clear, then I opened a new call credit spread in the July expiration. And that was basically at the same strikes, and I was just betting here that by exactly putting the same call credit spread in the next expiration, the trade would come back in my favor. And if we look what happened before, so remember that I had sold the 38 strikes, so it means that ideally I want the stock to go below that threshold. So after that, once I had sold my new call credit spread in the July expiration, I just had to wait and see how my trade would go. And if we look at, for example, the chart on GDX, you can see that after a while, around June 14, the GDX went down actually, and even gapped down one day on June 16, where it went from $37 per share to around $35 per share. And by actually having this movement, this big down move, that allowed my trade to come back back in a profit. And if we look at the transactions that I've been doing after that, you see that on June 14th, I actually closed my call credit spread. And why did I do this? Well, because if we take into account, for example, the losses that I took, and if we look at when I closed my trade on June 14, you see that overall I made a profit of $1. So why did I close my trade when actually my trade was going to come back in my favor? Well, the reason why I closed it that early, and that's a personal preference, and not everyone is doing this, but that's completely fair. That's only me, and I'm going to explain you why. Well, when I roll a trade, that means that I'm taking a loss, right? On this, we all agree. And because I took a loss, I want to get back that money. I want to get back that money. And my philosophy is that if my new trade that I put in the next expiration comes back in my favor and allows me to actually recoup the previous loss that I had, I'm going to get out and take back the money that I lost, and then I'm going to be out. I don't want to be too greedy and try to make a lot of money on a trade that I rolled and try to make, always more and more. And of course, I get, and that's completely fair, if you want to stay in the trade so as to make more money, so as to make actually the risk worth taking. But me personally, my personal preference is that if I manage to actually get back the losses that I had on the previous trade, then I'm out and I'm going to stop there. That's why I closed it on June 14th, and I didn't let it longer, because I could have let it longer and just made more money out of it. But I'd rather close it, cash my profits, and actually recoup the losses that I had on the previous trade. And actually I haven't lost money on those trades. And I know that by doing this, I might miss out on some potential good movements, because actually I rolled my trade. So if the trade continues to go in my favor, then I could make a lot more money. And I get it. I get that I'm missing out on that side, but personally, I'm fine with recouping my losses and just stopping there. Another trade that went against me was on XLF. So if we look at the chart of XLF, on April 29th, basically end of April, I sold a call credit spread again, and my short call was at the 37 strike, meaning that if XLF was staying below the 37 threshold by the June expiration, then my call would have expired worthless. However, you can see that it was actually a different story, because after May, basically beginning of May, XLF went past my strike, and so I had my call credit spread, at least the short call, that was in the money. So same thing as GDX, I had to make a decision on what to do with that trade. Should I just take my loss and move on, or should I roll it? Well, exactly like GDX, I decided to roll my trade to the July expiration. So if we look at my transaction statements, you can see that I sold on April 29 my call credit spread, and then on May 27, I think it was exactly the same day, by the way, where I rolled my GDX trade. Well, on May 27, I closed my call credit spread expiring in the June expiration, so taking a loss of $57, as you can see up there. And then I sold a new call credit spread on the same day in the July expiration, exactly at the same strikes. So once again, exactly like on GDX, I was betting that by just giving more time for my trade to be right, it would come back in my favor. And if we look at what happened, well, that's exactly what happened. You see that XLF actually fell exactly like GDX, like around the June 17, it actually fell quite a lot. And even before, it was coming back already in my favor. And if we look at my transaction statements again, if we take into account in June 14, you can see that I closed my call credit spread that was expiring in the July expiration. You can see that overall I had a very small loss of $2 on all those different trades. So basically, when I saw that I recouped most of my loss from the June 18 trade, well, I just, closed my trade, and that was overall a small loss of $2. So of course, and I get it, I could have let it and earned more than this and just made a profit overall, but just recouping the loss, I mean, there is one rule overall that I try to follow, is just don't lose money. Whatever you do, just don't lose money. That's why my philosophy is that if I see that the new trade that I have actually recoups the losses that I had on the previous trade, then I'm already happy. And I don't mind if I don't necessarily make a profit on that trade, as long as I don't lose money. I mean, you see here, I had a small loss of $2, and I'm fine with that. As long as I don't lose money, for me, that's the most important thing. After that, nothing prevents you from letting your trade on and not just taking your trade and taking your profit like I did. You could absolutely let your trade and see how far you can go and see how much money you can make. However, be aware of one thing. You don't want to find yourself in a position where you roll the trade, it's coming back in your favor, and then it's going again against you, and you just missed an opportunity to really cash in those profits and recoup the loss that you had on your previous trade. So that's why my philosophy is more about trying to not lose money. And if I break even, I'm happy, I don't need more. I will make money on other trades, I'm not worried about this. But when I roll a trade, my philosophy is really to focus on recouping the loss that I had on the previous trade. That's really my first goal. I hope that video will have helped you maybe put a bit of context around rolling trades and show you actually some actual examples of how did I roll trades, how did they go after that, how I managed to recoup some losses that I had on previous trades. I hope that this will have been helpful for you if you're also trying to roll some trades yourself. If you have any question, I'd be happy to answer any question that you might have. I know that rolling trades is usually a topic that can be a bit complicated to understand, so if you have any question, I'd be happy to help you if you have any. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.